Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Friday, 25th July. Coming up on the show, could President Trump fire Fed Chair Jerome Powell? I just don't think it is necessary. That's what the president said as he seemed to take a softer tone following his very public clash with Jay Powell yesterday. We'll give you the market reaction to all of that. Plus, we'll have the latest update on trade deals as the president visits the UK to seemingly cross some T's and dot some I's on a trade deal that was signed last month. And a look at what makes a stock a meme stock. So grab your coffee and let's own the morning. Let's kick off the things you need to know before the opening bell rings by taking a look at the markets in Asia. Now, all the major indices there closed down, as you can see. Don't forget, on Thursday, the Nikkei actually hit a record high at one point after that trade deal was struck between Japan and the US earlier in the week. Now, in Europe, markets on the whole are also currently looking pretty subdued there. The UK's FTSE 100 falling from recent record levels too. So why the negativity in Asia and Europe? Well, there seems to be a great deal of nervousness as we approach the August 1st trade deadline. Now, the president is visiting Scotland this week. He's due to have an informal meeting with the UK Prime Minister Keir Starmer to, quote, refine the recent trade deal, according to the White House. While the deal kicked in at the end of last month, there are parts of it that aren't quite complete. For example, a pledge to remove 25% tariffs on UK steel and aluminium. The rest of the world was hit with a 50% tariff. Now, the European Union believes a deal with the US is, quote, within reach. It looks like a 15% levy is where things will fall, but reports suggest that the 50% levy on steel and aluminium will remain in place. Now, the next thing you need to know about before the opening bell rings is that the US regulator has approved the $8.4 billion merger of Paramount and Skydance. Now, remember, Paramount paid $16 million to settle a Trump lawsuit over a 60 Minutes interview. The regulator insisted that the settlement had nothing to do with it, granting the approval. Paramount shares in pre-market are trading higher, up there just over 1.2%. Now, Skydance, you may recall, is owned by David Ellison. He's the son of a close Trump ally and tech billionaire, Larry Ellison. OK, now let's take a look at where US futures stand as we go to the final thing you need to know before the opening bell rings. And unlike Asia and Europe, we have a much more positive outlook. Why? Well, the president visited the $2.5 billion renovation project of the Fed, where he met Fed Chair Jerome Powell. They clashed, as you saw here on Yahoo Finance. But after the visit, it seems that President Trump's stance to the future of the head of the central bank seemed to soften. Investors seem to have taken heart from that. Firing a Fed chair clearly would have rattled them. Now, next week, the Fed meets. It's expected to keep rates on hold. Now, we know the president wants them to be cut, but the Fed chair has been pretty adamant that unless the data, especially inflation, comes into line, rates won't be cut anytime soon. StoneX's senior advisor, John Hilsenrath, gave his take to my colleague, Josh Lipton, on the Fed and whether its independence had already been compromised.
I think what the president is trying to do and what his allies in Congress are trying to do is humiliate the Fed chairman. I don't think in the end that it's going to affect the Fed's decisions about interest rates. The president has made very clear that he wants the Fed to cut the interest rate all the way to 1%. Powell doesn't show really any instinct, any inclination to do it. So, you know, in terms of the Fed's cost overruns on these buildings, certainly these are big projects and the Fed runs some very big budgets and it warrants scrutiny. But I think the idea of tying that to a pressure campaign to get the Fed to cut interest rates is going to backfire.
You argue, John, that the Fed's independence, I think you make the case that it's already been compromised by Washington politics. Walk us through that.
Well, you know, as I said a moment ago, the president is clearly trying to humiliate the Fed chairman. And I think there's a lot of talk right now in Washington about efforts to get the Fed chairman to quit or to fire him. I actually think the most important thing going on right now in terms of the Fed's independence is what's happening for the successor to the Fed chairman. So Powell is leaving his job one way or another next year, in a year's time, less than a year, by next May. And then the big question becomes who succeeds him. And I think it's the president is making very clear that his successor is expected to cut interest rates. So whoever gets the job is going to have to make some implicit or explicit promise to the president of the United States that he's cutting interest rates. And to me, that's compromised independence. I don't think Jay Powell is going to budge on this issue until he thinks it's right to cut rates. And I think efforts to humiliate him or to pressure him out of the job aren't going to work. But his successor is in this very difficult position where he's got to promise the president what he wants in order to get the job. And frankly, it isn't at all clear to me that interest rate cuts are what we need right now. Let's not forget, the inflation rate is over the Fed's target. It's above 2%. And I would not be at all surprised to see that inflation rate rising in the next few months.
Okay, so for moving markets, we're going to be looking at the auto sector. Let's start in Germany and Volkswagen. It's just lowered its financial outlook for the year. Why? Well, it blames the escalating cost of President Trump's tariffs, especially on its Audi and Porsche brands. US duties have added over, get this, $1.5 billion to costs just for the first half of this year alone. It's also cited internal restructuring expenses and greater sales of lower margin EVs for the change to its forecast. Initially, shares fell on the news but have rebounded since. Now, Europe's largest car maker is under pressure in its key markets. The US, because of tariffs. In Europe, it's facing weaker demand and also higher production costs. And in China, consumers there are looking more at local brands. And VW aren't the only automaker today to put a number on the cost of tariffs. In South Korea, Kia said that its operating profit in the second quarter slumped by $570 million from US tariffs and warned of an even bigger blow in the second half of 2025. Kia's shares slipped as a result of the revelation. However, the company also said that it aims to increase US sales and market share in the second half. It's pinning its hopes on the sales of new hybrid and gasoline vehicles. Also, some of its rivals are expected to raise prices in order to cope with tariffs. That's something that Kia and its subsidiary Hyundai are keen to avoid doing themselves. Now, coming up next week, we'll bring you an interview that I did with the acting CEO of Zeekr in Europe, Lothar Schuppert, the Chinese luxury EV maker. You won't want to miss what he had to say on tariffs and the state of the car market. Okay, it's time for a quick break. But before we dive into trending tickers, Jared Blickery will share some very actionable tips for your next trade and much more. Welcome back. Yesterday on the show, we talked about soaring cyclical stocks and defensives that are now lagging. Now, in the latest episode of Stocks in Translation, Yahoo Finance markets and data editor Jared Blickery explains how investors can play both sides.
The S&P 500 is up nearly 30% off the April lows, and Wednesday we took a look at cyclicals versus defensive sectors and how those poor defensive have gotten no love recently. Today I'm going to show you how to play these two different groups with an introduction and a way to enhance your portfolios with commodity futures. But first, let's do a brief recap of some of the basics that we covered yesterday. First, we want to take a look at the defensive sector definition. These are industries whose demand stays steady and booms or bust so that earnings and share prices move less with the economy. They're stable, in other words. And these we have four sectors: consumer staples, we have healthcare, utilities, and energy. And yes, energy is kind of a gray area, but we talked about that yesterday. Now we also have the cyclicals. These are industries and groups whose sales and profits swell in economic expansions. They shrink in recessions, and that makes their stocks swing more than the general market. And here we have the remaining 7 sectors, the large cap sectors, at least, that we define the S&P 500 by: consumer discretionary, industrials, materials, financials, tech, communication services, and real estate. And yes, there are some gray areas there too, especially with tech and communication services, but we move on. I just wanted to show this chart again too, because I think it's so incredible. This goes back to 1990, and this shows you the defensive sectors, how much they took up as part of the S&P 500. They started out at 40% in 1990. They moved up a little bit, but now they are at 20%. And then you take a look at 2 stocks only. This is NVIDIA and Microsoft, and they are now taking up 15%. So this just illustrates how much these stocks have become unloved, those defensive sector stocks. So as promised, I'm going to show you some ETFs on how to play. And by the way, a lot of this work comes from Todd Sohn over at Strategas ETF Research, and these are his basket here. So here we have a bunch of cyclical ETFs, starting with ARQ. That is the ARC Autonomous and Innovation Fund, not the innovation, the ARC Autonomous and Robotics Fund. That is up over 66%. That's twice what the S&P 500 is up. And then we have 2 ETFs that cover the semiconductors, SOX, which you might know, and XSD. Both of those also up almost 2x the S&P 500. Then we have high beta. That's up 50%. What is beta? That's almost like the stock trading at a multiple of the general market. So a beta of 2 is twice what the S&P 500 is doing. Those are doing well. Those are cyclicals. And then it's interesting. We have a broker-based ETF. That's up 43%. And here's the year-to-date, still holding on to gains of 21%. So we do have financials in there. Then we have another one, KBW Bank Index. That's another financial-driven one. Then we've got some other interesting ones. We've got PAVE, which is infrastructure. And also we have IWM down there. You might know that as a Russell 2000 ETF. So that's a very cyclically oriented index. And you can also break that up into groups. But we got to get to some of our defensives here. So PKW is a buyback fund. And so the top 2 in there, I believe, are Wells Fargo and PayPal. And yes, this is a defensive, but 2 of those stocks are arguably cyclical. So it just goes to show you some of the gray area that we're dealing with here. But stocks that can do strong buyback programs, they have a bit of defensiveness worked into them. Also, we have the RSP, that is the S&P 500 equal weight ETF. Since the market cap ETF is so highly weighted to those big stocks, this one is arguably a bit more defensive. You can see that's up 7% year to date. Then we have cows. This is a cash cows ETF. You'll see stocks like Nike and Ford at the very top of that. The theory being that cash flows, those strong cash flows, make those stocks a little bit more defensive, even though a lot of times they're classified as cyclicals. At the very bottom, the worst performer, XLV. That is a standard SPDR healthcare ETF for large cap healthcare and pharmaceuticals. That's only up about 2.2% since the April bottom. And it looks like I'm out of time here, so I'm going to have to show you how to add managed futures to your portfolio and help balance it tomorrow. But I do promise to do that. In the meantime, tune into the Stocks in Translation podcast for more market decoding deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
Great tips from Jared there. Up next, we'll be unpacking what's happening with some big stocks. That's just after a short break. Welcome back for our trending tickers. We start with Puma. Stock of the sportswear brand has been very active this morning, but not in a good way. Shares sank more than 18% this morning after Puma posted a 2% decline in sales for the second quarter to $2.27 billion. For the year, Puma says it now expects a low double-digit decline in currency-adjusted sales and a loss, while its previous guidance stood at more than $500 million. The company cited softer top-line development, increased currency headwinds, and of course the impact of US tariffs. Puma, whose production is mostly in Asia, is the latest clothing brand to warn about the negative impact of tariffs, joining Nike and Lululemon. Okay, our second ticker today is another struggling European giant, LVMH. The owner of Tiffany & Co. jumped by as much as 5.1% this morning. Now it's trading at around plus 3.3% after analysts said the worst is probably behind it for the luxury group. Now, HSBC analysts said that even though LVMH posted a 4% fall in revenue in the first half of first half to 39.8 billion euros. That's about $47 billion. The company is implementing efficiencies, and there's a glimmer of hope that the sales decline has troughed. Deutsche Bank said the first half of the year was, quote, better than feared. Still, it's been a terrible time for LVMH, which has been surpassed by its arch rival Hermes and has tumbled nearly 35% over the past 6 months. And now from European fashion to AI chips. Shares of Intel fell more than 8% in pre-market trading after it reported mixed second quarter results yesterday evening. It's now trading just under 7.5% there. Now, Intel delivered revenue of $12.8 billion, beating estimates of $11.8 billion. However, the chipmaker announced a loss of 10 cents per share instead of expected earnings of 1 cent per share. Lip-Bu Tan, who was appointed CEO in March, is on a mission to turn around the chipmaker. He says the company is laser-focused on its AI roadmap, as well as building more financially disciplined operations. Intel said it's cutting its headcount by 15%. So what's Intel's strategy for the future in an increasingly competitive AI chip race? Well, to get more clarity on that question, my colleague Josh Lipton spoke with Bob O'Donnell, president of TECHnalysis Research.
Revenue numbers for this quarter were higher than expected, and most importantly, of course, the forecast was higher. I mean, look, there have been challenges, and I understand the point that you guys were just discussing. Intel does, I believe, really want to be both a chip maker and a chip designer, and they really are trying to figure out that path. Look, Lip-Bu's only been in there for a quarter. The kind of changes they need to make are more than a quarter long, right? I mean, this is a multi-quarter, realistically probably multi-year kind of complete turnaround story before all the benefits start to show up. A couple interesting things.
Let me ask you, Bob, just to stop you there, because I think you're touching on an important point. And I have lots of questions on the metrics of this print, Bob, and we'll get into that. But you're touching on an important point, which I do think there is this broader question out there, Bob, about what Intel is going to be. You know, what is the game plan here? What is the strategy, Bob? We were talking earlier to our colleague Dan Howley about this, how honestly, Bob, we really don't talk about Intel that much on the show. We talk about NVIDIA, AMD, Broadcom, Micron. It feels like Intel is not in the conversation. So what is the game plan here moving forward?
Well, look, the game plan is they're going to focus obviously on x86, which let's not forget. I mean, there's still several 100 million PCs get sold every year. Lots of servers get sold every year. Intel owns the vast majority of the CPUs in those systems. And even in the NVIDIA, the big stacks, up at the top of the rack, there's an Intel Xeon CPU in there. Now, as a percentage of the total BOM, it's still pretty small now, but it's still there is the point. So you're going to see them build their own products, sell their own products. You're going to see them start to try and build more products for other people. That's the foundry side of the business. The way this thing was constructed, the reason why it's been such a challenge is they were so intertwined, making for themselves versus trying to make for other people. And so now as they tear those pieces apart, it's been painful, right? Clearly, it's been a big challenge for them to try and clarify all of that.
And finally, meme stocks are having a moment this summer. Retail investors with an appetite for risk have been causing wild price swings for some stocks with little fundamentals to explain the trades. Here you can see 3 examples: the action camera maker GoPro, donut chain Krispy Kreme, and the real estate platform Opendoor. But some investors out there are actually rejecting the meme stock label. Eric Jackson of EMJ Capital is the man behind the Opendoor rally. He explained to Yahoo Finance's Julie Hyman why he's so bullish.
The reason why I'm so excited about Opendoor is that I don't think it's a meme stock. The post predates all this meme stock mania. Carvana wasn't a meme stock, and Opendoor is not a meme stock. This is a real turnaround, legitimate turnaround story. It's an opportunity for anybody who missed Carvana, and I missed it at $350. I got in at $15 on Carvana, so I think I do know what to look for in these kinds of situations, and I think that this is the ground floor for a move to 82. So. Something could happen to change my mind, but the plan is to stick with this and sit on my hands and let this thing compound.
So for people who maybe just have seen it as a meme stock or don't know what it is, this is a mobile platform for buying and selling real estate. Zillow was in that business and got out of it because they weren't making any money on it. And, at least if I look at the average Wall Street forecast, this thing is not expected to make money as far as the eye can see. So what are you seeing here? What's your bull case?
Well, I mean, nobody thought Carvana could make money. There was a time where nobody thought Uber could make money on a large national or international platform basis. So it's not unusual when you kind of e-commerceify or webify some kind of previously large fragmented industry plagued with kind of legacy kind of ways of purchasing, whether it's the agents in the case of real estate or the dealers in the case of cars and Carvana. So iBuying is difficult. It's tough to make money. And I have been bullish on Opendoor before and have been wrong because I have been too early, which is the same as being wrong, because this thing has taken much longer since Powell raised interest rates and made it much, much more difficult to kind of get this thing to a steady state profitability. And so the reason why it got to 50 cents a few weeks ago is that Wall Street and most investors assume that this thing was just going to go, file for bankruptcy. It's not going to make it, just like what happened with Carvana in 2022 when it goes from $400 to $350. So I don't think it will. I think they are going to have earnings in a couple of weeks, and they're going to announce like their first EBITDA positive quarter in about 3 years. And they might not guide to kind of profits forevermore, but I think they're going to give some hints in that direction. And I think basically this is a business on the road to, within 6 months, steady state profitability. And the turn in the stock always comes before the proof that a company has reached steady state profitability. So I might be wrong. I've been wrong before about Opendoor, but I was wrong about Carvana. I didn't jump in at $350. I jumped in at $15, and that I still did great. But this time I'm sort of leading with my chin more and saying now's the time to buy. When it was under $1, it's still at $2. People say, "Oh, I missed the move, Julie. Oh, Eric, tell me about tweet me the next one." I mean, we're talking about a stock that could go to $82. You didn't miss the move.
Almost all we've got time for. Let's have a quick look at where US futures stand as we approach the opening bell. Everything there everything apart from the Nasdaq in the green there. Perhaps a bit more positive now after the Fed chair seems secure in his role for now. Okay, that's it for Market Sunrise for this morning. Next up, my colleagues in the US will break down fresh trade data showing that tariff disputes are disrupting commerce. We'll tell you what that means for the economy. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali.